Cool. Thank y'all for coming. Appreciate having you guys here. I'm very excited. I'm going to record this. I've had a couple people ask that I get this down recorded because it is a topic that is definitely going to become relevant this summertime. Essentially, the question is what is an assumable mortgage? Okay. And a couple people coming in. Come on in, ladies. Come on in. So, an assumable rate mortgage is one where you could take on the rest of the balance of the note and the same interest rate, okay, that the previous owner had. Very simple, okay? Duh. But let's break that down for a little bit, okay? What type of loans are assumable? There are two types, okay? Is conventional assumable? No. Conventional loans are not assumable, okay? Is FHA assumable?
Yes.
Yes. Is a VA loan assumable? It is assumable in general, but it could have an impact on the previous owner financially if it's not another veteran. So let's start with what we're gonna do with this, guys. Is I'm gonna take us through the basics, and we're gonna build up through like what is an assumable rate mortgage, how do you identify them, how do you work with them, and how do you talk about them? Okay. So at the very beginning, you guys need to understand it's only an FHA or VA, and VA with an asterisk. So Jack, like when you're talking about an assumable rate mortgage, what is the challenge that a VA loan has for people assuming it?
Okay, anybody can assume a VA loan.
Speak up really loud if you don't mind.
Yeah, anybody can assume a VA loan.
Okay.
But if the person that's assuming it is not a veteran, the eligibility gets tied up.
Okay.
So if I was a veteran and I had a VA loan, I would require the person that took over the assumption was a veteran.
So
I wouldn't offer it to an person
that's not a veteran.
Yeah.
So you can only you have a fixed amount of VA value that you can use up as a veteran towards your VA loan, okay? Just to put it really simply.
Yeah.
And if you have a non-veteran assume your loan, you still lose access to that money.
Right.
Okay? Until that thing is, I think, refinanced. They have to even
sold.
If they don't refinance.
Sold.
Wow. So it's really messed up.
If you're a veteran and you buy a house with a VA loan, even though it's paid off, your eligibility is tied up in that house until the house is sold.
Wow.
It's not paid off, it's sold.
So the point is, if you identify a property with a VA loan on it that's assumable, it's highly unlikely that they're going to let a non-veteran assume it. Does that make sense, everyone? I think we're being pretty clear on that. Okay, let's talk about how this works, okay? Very simply. So you have, let's say you identify a home, okay? This property, okay, was bought in 2021, okay? They bought it and they got a loan on it for $250K loan. They bought it, let's say they bought it for $280K, and they got a loan for $250K. Is everyone still with me on this? Okay, it's very simple. And now the home, they're selling the home now in 2026, okay? This is an FHA loan. Let's say they got that at 3% interest rate, 3% interest rate, $250K. What's happened to that in 5 years, that balance? It's gone down a little bit, okay? A little bit. Like I'm gonna just roughly guess that they owe on it now about $240K.
Yeah.
Is that a fair number? Pretty dang close. Okay, so now they owe $240K, and what interest rate is that at? 3%. So it's at 3% interest rate. The home value has gone up, right? Okay, so let's say the home is now worth $265K, okay? $265K sales price. An assumable loan lets me take that balance, take over that loan at 3%. Okay? But here's the deal. What am I buying the home for? 265.
Right.
Okay. So I would have to bring what? 25K cash to get to the 265K. Okay, does that make sense? So
Plus closing costs.
my closing costs too, which are we'll get into those details in just a little bit. But in essence, you are bringing the cash, in general, bringing the cash difference between the balance of the loan and whatever you're buying it for. Okay, but everybody good on this? I know this is a lot of information. That would be your down payment. Okay? The financed amount would be the 240K. Now, let's do the math on this. Guys, how much of a difference, let's say, what are our interest rates? Let's say 6.25, okay, for fun, okay? Calc. A loan of 240K times 0.0625, that's $15,000 of interest a year, okay? So let's talk about how different this is. Now, 240,000 times 0.03. Less than half. Less than half. Okay? What's 7,400? 7,400, about that amount, divided by 12. That's a difference of over $600 a month. Okay. Is that a game changer? That's a game changer, guys. That's so like you're like, oh my gosh, if I could find these properties and you could pull this off, how do you think your client is going to see you?
Yep. Happened. Yeah.
It's happened. So okay, so we've gone over kind of the basics. This is the debate at a very basic level. This is how this works. You find a property with an FHA or VA loan, typically FHA unless you're working with a veteran client, and you're going to need to talk to that agent. They might not even know that this is an option on the table. They might not have even considered this themselves. You might be the one directly approaching them about it, this opportunity. So, okay, we've talked about what this is. Closing costs. Let's talk about some of the financial details. Closing costs on this type of loan are less than normal loan. I think it's pretty. I think 1.5% total or something.
We don't. The servicer does all these. We don't do them. So I mean, I don't know what they are.
Closing costs were pretty low, as I recall.
Yeah,
Right?
2,400.
What's that?
We capped it at 2,400 for the lender fees.
Yes.
But we don't know what the rest of the
You have to have all the title fees, everything.
Title fees.
You have to have all title fees and everything.
But specifically the loans, what I'm talking
Yeah.
about. The cost of getting the loan is less. Okay, so you're going. How much is that going to be? You're going to have to communicate with the lien holder. Okay, so we've talked about there's a little bit of closing costs, just like with a normal loan. So keep in mind, like when you're negotiating this, the client's going to have cash because you ask the seller to pay for this. You're just taking over the note and just throwing them some money. You're just eating into the sales price. This all just totally eats into their sales price, what they make at closing. Okay, so you got to be really aware. They're not making, when they have a note like that and it's really tight, they might not have a lot of cash. So you're going to have to you might have to cover that amount or expect your client to come up with the cash for typically about 1% is the rule of thumb that I've been hearing about. How can you get the final number? You're going to have to consult with the lien holder, the original lien holder. Okay? So there will be some closing costs. You will have your normal title costs of $1,600 to $2,200 or whatever it is, depending on the sales price. But it's very hard to expect the seller to pay for a lot of those things when there's no meat on the bone. Okay? Does that concept make sense?
Yeah.
Okay, we've talked about the basics of it. We've talked about the type of loan. Now, what if that difference is much more? Okay? What if that difference is, instead of this 240K, let's say it's 200K, and it's a 265K home. That's now a $65,000 difference. That's a lot harder. That's not as many clients are going to have that kind of cash, right? Okay, Jack, what's another option?
We can do standalone second liens.
Okay.
But there's a but to it all. Texas, it's considered almost the same as a Texas cash out. So the max you can get is an 80% loan to value. So on that 265, the most we could lend on second would be $12,000.
So
they're gonna have to come in with
80%, basically you could take 20% of the sales price.
They're gonna have to come in with 20%. So
They,
on a cash out loan, we can
Yeah.
only do 80% of the loan value.
okay.
On the standalone second like this, we can only go to 80% loan to value.
So
Cumulative loan to
basically, a 20, you'll only get the cash
value.
for about 20% would be the
up
20.
to 80% loan to value. The
Oh.
second lien and the first lien.
I see what
So
you're
they're
saying.
gonna have to come in with
Excuse me.
20%.
Okay, I had not heard this before.
Yes.
Okay,
I did the research on it. The max they're gonna have to bring in 20%.
so that bridge is they have to have at least a 20% down payment, essentially.
Yeah.
20% of equity and the rest can be loans.
Yeah.
Okay, so you're probably looking at about a 20% down payment.
Right.
All right, let's do a new one and kind of run the numbers on that because I can see some people getting confused. So if it's let's make it an
Make it
even
real
number.
simple.
Let's make it a 100K home.
Yeah.
Okay, 100K. What's the amount that can be financed? 80% of that.
80%.
So
80,000.
when you buy this, that 80K, all right, might be have a portion of it, like 60 of it might be the previous loan. You'll only get 20%. You only have a loan balance up to the 80K, and you're going to have a down payment of 20% at least. Does that make sense, guys?
20% of
$20,000.
You have to have 20% cash. The loan, any combination of the previous loan
Price.
with the assumed with the new loan, you can only finance up to 80%.
of the sales price or the loan?
Yeah,
the
so
sales price.
Of
Okay.
80% of the sales price.
Okay.
So like, let me make it even
So
bit.
they have to come in with 20,000
80%,
to close.
80K on the 100K property. Okay.
And that's getting that lien, that second loan.
So here, let's run an exercise. So we have 80% could be a loan on that property. Okay. Let's think about
Two
the
loans.
2 loans.
Two loans.
Yes, cumulative loans. Yeah.
What if the original loan, Asher, is 40K? How much can we get a loan for then? If 80K is the total amount we can have of loans. The original loan's 40K. What can the second loan be for?
I'm not sure.
Okay, let's go over this again. 80%. They will give us loans, combination of the original loan
Mm-hmm.
or the second loan to bridge the gap. The total loan amount is 80K. Okay?
Okay.
80% of 100K. So if the original loan on the property the balance of it is 40K, the bridge loan essentially is 40K.
Okay.
It has to add up to 80K.
Right.
So we're talking about how bridge the loan to catch up that difference is. Basically, guys, you have to have 20% cash down, and then that can help bridge that difference after that.
So in that certain circumstance, you have a bridge loan at 40K.
What's the
and then
second
your-
lien?
The second loan.
Standalone second.
Can you pay that
At a
together? or is
different
that usually
interest
separate?
They'll be separate payments.
They're separate
And
payments.
And
the rate's
different
probably around
interest
7%.
Yeah, which is the other key. And,
Yeah.
and that's where you have to do the math. You may get that 3%, but if that second bridge loan is at
Second
7.5%.
Yeah, second liens are running around 7.
Yeah.
You're going to have to make a judgment call at some point if it's worth it. So, like, okay, here's the gist. You want as close as possible that principal of that loan to be to the sales price, which is not hard to find for homes that were bought from 22 to like 2020 really. 2020 to around 2023 is your ideal target. Okay? Does that make sense, guys?
Why would that be?
Because the property values. Okay, that's a good question. Let's look at this here.
And I'm just asking statistically wise, like why 2020 to 2021? Why not? You know,
So from 2020
Interest rates were
interest rates
to
okay.
2022ish,
Okay.
somewhere around there, lower interest rates, and the sales price has not gone up much.
Okay.
since
Makes sense.
yeah,
Makes
And
sense.
remember,
because you were buying at the peak of the market during
Right.
that time too.
Price has been a flat line. Okay, so lower interest rates and the sales price has not gone up.
oh, sorry.
No, go ahead.
On a 30-year AM loan, the first 5 So you're not paying down
The debt.
a lot.
Remember to speak up, because that microphone, if it's hearing you across the room, I'm trying to catch it. So the idea, like that target range of dates is the ideal time to search for a home. Okay, so you need to be able to understand that in the last 4 years you could take off about 2 to 4% of the principal has gone down in 5 years. 2 to 4%, right around there. Okay. So you understand that whatever they bought it for, and how can you find what that loan is? Courthouse retrieval system. Okay, you can find the initial loan, or you can ask the agent even if you're not seeing it come up automatically. So when you go in the MLS, you can look at the courthouse retrieval system, and you can pull it up. I mean here. Let's just for fun, we'll go over here. I'll log into MLS. MLS. Let's log in. Okay. I log in and I'll show you that section really quick. There we go. Okay. Courthouse retrieval is down in the bottom right, but you can also pull it up on specific properties. So someone give me an address of a home. Here we go. Horn. Here's something in Converse. I go in here. I go down. It's in Lennar, built in 23. I can click on the county account number here real quick, and I can look up here, and here's an auto link to the CRS on it. Okay. So I click on the CRS courthouse retrieval system. I could scroll down and I could see, okay, here we go. 2023, here it is. $237, $124 is the loan. There we go. And the value of that property has probably not gone up much in that time at all. At all.
Look, retro rate, that's what it shows you.
So, and I was going to talk on that. Retro rate was bugged for me this morning, like when I was trying to log in, and Brian. So there is a program we showed at the sales meeting, and I mean, I can try accessing it again. If someone wants to try logging in, are you on retro
I
rate?
just pulled it up. I mean, that's so it's showing all of that. Is
Why
that
did it work for you? Maybe it's
That's
working
the
again.
mobile.
The mobile?
She's got the mobile, but you can check.
Yeah,
she
let's
said
see if it's working
they
again.
fixed it.
How would I access it from here? How do I access? Do I have to go back to the one access thing, or can I?
Yeah.
go to
Yeah.
apps on your home?
Can I go back to one access from here, or do I have to literally go log back
Your
in?
tools and resources, Brad. You had it right there. More and then tools and resources.
Oh, do they have it under here under more?
I believe so.
Tools, resources. I don't see retro rate on there. I think I have to literally go back to one access. Okay, it's easy enough to do. Hold on.
Savored up my solid.
Sabor one. Yeah. There we go. Whatever. All right. But one access login. Maybe it'll pull me in through there. Okay, here we go. Perfect. Good. It's tied me in. So mysolidearth.com. Yep, that's it. So it is .solid earth. And let's go down and see if retro rate is working again. Hopefully. Maybe. That'd be great. Okay. Oh, it's back. What the? This is ridiculous. It was not working earlier. We had like all these people trying to log in. Yay. Okay. Now this is great. Now we're back into teaching because, all right, so again, going back to this, we're talking about that difference. You want to find the principal to balance as close as possible to the sales price. Simple enough. How do you find homes like that where you can assume the loan? Retro rate. Guys, this thing is badass. Like, this is so cool. So, like, let's have some fun. I go under search and, like, filters. Let's have some fun. Interest rates below 4%. And then I think I can filter by, I want only houses. Okay. And I want only FHA. and I only want active. Because why don't I want active option, guys? I want things I can actually buy.
Right.
Okay.
The CRM for comps.
Bingo. Perfect. And so, look at this magic. This is insane.
That is pretty great.
Can't you filter it too by the low?
The down here. Oh yeah, amount of down payment too. Here we go.
Is it sort?
The max price. It's not the loan type. Where is it by down
Sort.
payment?
Is it sort where you could do highs and lows?
I don't think it's on filters. It's on the
Sort.
recommended, right? Like the sort,
Yeah, there you
and
go.
then yeah, and then now you go to down payment.
Low to high. Here we go.
So,
All right, here we go.
so
so-
that negative mean there is no money due? When it has no money
It means the balance of the loan is above. It's super underwater. The balance of the loan is below the value of the property.
due? So meaning no.
Be,
No
be
gap.
careful on that.
Oh.
Yeah.
That loan, that
So you ain't got
probably
nothing down.
own
You just take over it.
but 160
Yeah.
on that house. So you're gonna assume it at 160.
And this is based on what they're asking for the home. Okay? Remember that. This is what they're asking. So, like, let's look at Village Crest. Here we go. 22K down, 2.8%. Look at this. So you have a first-time home buyer wanting to get into a home. Looks like it's a little pretty clean. Maybe a little bit of cleaning up could be done, or there's obviously a few issues. But guys, how much are you saving? It's an insane opportunity for people who are looking to get in, especially looking to get in their first homes or looking to get a deal. Luxury buyers, or getting that, this really gets interesting is the 700 and 900K range, where home prices might not have gone up at all in certain areas on the outskirts of San Antonio, where like that you could basically have, oh shoot, good job. I'm sure everyone's gonna love that on the recording. You could have a 2.8% interest rate on a 600K home. Pretty cool, eh? All right, so like you search through here, like what is this doing? This calculation is very simple. The down payment that it's doing is it's taking the asking sales price into the difference of what they owe. Okay? Now, can you negotiate? Obviously. But if there's not a lot of meat on the bone, guys, because what do they have? Now, remember, guys, who has to get paid out of that 20K? Like, let's say you bought that home and you gave him 20K cash. What expenses is that seller going to have to pay? Commission.
Yeah.
Okay, be aware, you're dealing with tight cash margins on that. So be careful on that as far as how you negotiate. You're probably not going to, your client might have to bring additional cash to make this work. That means that seller has 20K on 150K, let's say it's 200K property. Okay, let's do the math. 6% of 200K, that's 12K. 12K right there out of that 20K is gone. Okay, for commissions. Okay, then they're going to have title cost, 2K. That's up to now 14K. So like, the buyer will have inspections and stuff like that. But like when I'm saying seller, what that seller has, they're walking away at closing with maybe 5K, 4 to 5K. Does that make? Go ahead.
Can you send this information to clients?
Yes, you can. You can send that to people.
How?
As I recall, I can take that property and where was it on here? I can favorite it, or you can go in the MLS and find the property and send it through the MLS to them.
Well, yeah.
Brian, were you able to send that to someone?
This
Yeah,
information?
I did it through, I went through the MLS.
I don't know if I can
MLS
directly
number.
send
Just
through
send it.
here.
Wasn't there a meeting last week when we talked about sending this information to our clients? Like on
Yes.
county-based?
So
That
my
was the
favorites.
neighborhood one.
Oh,
That
it's a
was
different
the
one.
one.
Yeah, like
Resource
here,
Center.
watch this. I'll take this property, I'll favorite it. Okay, I'll go to my favorites. I'm
Try
not.
safe search. See if that does it.
You can
Usually in MLS,
search.
You can do safe search and add a client there.
I cannot add a client. This is not meant to be for clients.
Okay.
Okay.
Okay, okay. So I just.
I pulled them off the MLS number in MLS and then just sent
This is a
Yeah,
realtor tool.
Yeah.
Okay,
Understood.
this is not public data. So you could take a screenshot and send it over to
Yeah.
someone, or send it, but like I'm not aware of a way to send it.
Actually, I asked them that question.
And
And
what
so
did they say?
it has to be an individual property. There's a link at the top for sharing that one
I did
specific
not
property.
see.
Yeah, it was in there. It was like hard.com,
Yeah,
something like
but
that.
yeah, you can only
It
do
was
one.
tough.
Okay, and that's it's just the MLS link is what it is. It's not like I don't think it's an actual link to this data. The rod. Let me check.
Oh, okay.
See this home on HAR. Yep, there it is right there. You see that? I go view on HAR.
Well, there's a link at the top when you're on that map page that says copy shareable link and stuff.
All right, let's go look up here and play with that because I was not aware of sending it, that full data sheet to someone from here. And I could be wrong. I mean, like this is a pretty new tool, but when I was playing with it, okay, where were you seeing this, Joy?
We'll see the picture is showing it. Proper filters. You can see it's right there. Let's see switch.
Okay, I'm not seeing that
Yeah,
on
no,
here.
I'll read through it.
Okay, if I find it, I'll post it because like the only way I found was the link next to the properties, which is literally just the MLS sheet, a public MLS page for the property. So if I find another way, we'll go with it. But like you can identify these properties and go from there. Now let's talk about. Okay, so we found out how to identify properties. Does anyone understand? Have any questions on how this math works? I see some thinking here. Like I know this is a little bit of a funny thing. Let's get some questions out of the way.
Let me make sure it's
Rochelle.
is it the bridge or the gap? Is it called a bridge? Or
So it's just a loan, a second loan is the term. I'm using the phrase bridge to help make that connection. The problem is like you can only get loans up to that 80% of the value of the home.
So the
And that's in
bridge,
Texas.
the
In
bridge
Texas.
is the ask and sell price minus the difference owed on the loan. Is that what creates that, like, so for
That is what they're asking
Yes.
for. Balance of the loan, what they're asking. Yes. So if you made a full price offer, that's the cash difference.
Okay, and then the buyer could get a second loan
Only up to 20. You'd still have to have a 20% down payment, pretty much.
with
Yeah.
all loans.
Yeah.
State of Texas.
State of Texas.
State of Texas, the max you can borrow
So-
cumulative loans is 80%.
After learning that and doing some research on that, the problem is that means you really are using this number as like you need to make sure that they have the cash for that because they're gonna have to at least be bringing 20% to the table. Yeah,
But that gets that interest rate.
it's a great.
And it's 5 years into the loan, so you're picking it up. You're instead of being 30, you're only paying 25, whatever's left on it.
Yeah, it is really quite
That
amazing.
is true.
So we've
Wow.
talked, yeah.
That's
So
pretty
we've
good.
talked about what type of properties you can go VA, FHA. We've talked about how the math works on that. Okay. Now we've talked about how to find them with this program, Retro Rate. Like you really want to be attentive to two big things: the interest rate, well, also the type of loan too. Type of loan, make sure it's FHA, or if you're a veteran, you can do VA. If you have a veteran buyer, there's so many of these properties out there like this, guys. You are okay. Let's talk on. We have a story. Brian, how's it coming on with that? Is it all looking good?
Yeah.
Did they
No,
close
we're
or do they have a
clo-
little?
No, we'll close in June now.
Okay.
It got moved.
I'm gonna-
This was not offered as a VA assumable, but once they found the house, it was overpriced based on what the comps were showing for that area. And instead of giving them a much
Speak up
lower
really loud,
price
yeah.
than what they were asking, I called the agent and just asked, what's going on with the seller. And he just said he's relocating, just got out of the military. The buyer that I was working with, it was military, is active duty military in the area that they wanted. And I just asked, is it an assumable? They went back to the seller. They called their lender. It was an assumable. And the price, they were asking $275. The payoff was $262. It was purchased in 21 at a low 2.75. So they were only going to have to bring So instead of us
No
we were-
sales price because it still hasn't closed
Yeah.
yet. But yeah,
No,
you can
but
imagine.
we came in at lower than what the payoff on it was, but they were willing to come in higher, knowing that they were getting the 2.75.
Your buyers.
Yeah.
The buyers, yeah, and it was going to underwriting this week with the lender. Everything's been submitted, and the reason that we had to move to closing is because the lender requires on assumptions that all closings happen between the 2nd and the 14th of the month, because they need 10 business days to transfer the loan, and they can't have it occur over a payment like the first of the month. Somebody has to be on the note paying at the first. So that was.
So
the
this
big-
is a pretty.
yeah,
So this is such a good story.
yeah,
VA seller, VA buyer, right? VA
Yep.
seller,
Yep.
veteran. So again, like anyone that has a veteran client, guys, this is insane. This opportunity to pull this off is like you could save someone on a high enough priced home $1,000 a month on their payment.
Brad,
No joke.
Every FHA, every VA loan is assumable.
Bingo.
It's not. They tell you it's not assumable.
It always is, by the way.
yeah.
Everyone is assumable.
So if you have a listing and it's a VA loan, it automatically goes on retro rate? Or
Yes, they're automatically popping it on there. Yep.
I have a question.
Sure.
So if I have a veteran, but they don't want the house for a veteran. They see an FHA house. Can they still
Yeah.
get it? Yeah. Okay.
They can assume that loan too. Then they're not even using up their VA benefits to do it. I mean, if it makes sense, if the math is good, it works.
Okay.
So, like, all right, now we've talked about how to identify the properties, what they are. Let's actually talk about how to make this work. Okay? I see a property I like that I think would be a good one for my client. First, I would talk to the listing agent. I would start with them. Once you've identified it, hey, can you confirm the balance? I would go as far as to confirm that they didn't do some kind of weird buy down on their interest rate or a refinance that's not being picked up. I do not know how authoritative or accurate that is, retro rate, because there are mistakes. I can assure you there absolutely are mistakes out there in the recording. So verify with the listing agent that information's true. Then stage 2 is ask them, would they consider doing an assumption? Find out if they would be willing to do that. There's very little. What are the arguments against doing an assumption? Time is probably the biggest one. How long is it taking for you to close? Like 60 days or something like that?
We will be at 60 days when it would have been about 45. Well, we pushed it 3 weeks, so it would have been 45 days. But we did that.
Yeah.
We did
VA,
take
what
it
about the
back.
FHA? They also take. Okay.
Plan, like, okay, conservative, generally 45, let's talk about timeline. Generally 45 days to close. Okay? Generally. All right. What could it go up to? 60. There could be surprise, and this is not the beaten path. Does that make sense, guys? This is not like, okay, everything is coming together perfectly. This is some sub-department of some lender managing it with sometimes weird rules on when they want to close. I've had lots of little quirky things come up, okay? The concept is I would ask for a 60-day closing, and I would consult and make sure that works with the listing agent. If they can't handle that, it might not work out, okay? But it's not going to close in 30 days. I want to make that crystal clear. Okay, so you found out they're willing to do it, okay? Now you need to run the numbers. You need to sit down with them. Jack, would you be willing to help someone kind of run some numbers? Yeah, I know you're not making anything on it. I'm sorry to ask, but
No.
Jack would be willing to at least run some numbers and help them understand what's going on. Okay? Talk to a friendly lender, get them to run some numbers on this. Okay? For what that'll look like. You can ask them what their payment is. Their payment will probably be pretty similar to what their payment is. Does that make sense? That's a good way to do this. I've done a few of these. So, like, I ask them, what's your payment at? Because that principal and interest rate, is that all there is to a monthly payment?
No.
No. Taxes, insurance. So let's say your veteran is not 100% disabled. The other veteran is. and you ask them what their monthly payment is, there's going to be a little difference in that, okay? Because of taxes. Just you need to. These are the little details you need to consider, especially when working with a veteran. FHA, it'd probably be pretty damn close. Okay, so you've confirmed, you've run the numbers for what their payment would be like, how much cash they would need. You're going to need to talk to that listing agent and explain to them everything's coming out of that down payment. So on any offer, you need to have commissions in there. You very rarely will have a seller willing to consider an offer where they're bringing cash to closing.
Right.
Does that make sense, guys?
Absolutely.
And does that mean your CMA might show you might have to go a little bit above asking price to make this work if they had not thought about it? If it's really tight margins? Yeah. You might be willing. Would your client be willing to bring a little extra cash to get a 2.8% interest rate? Yeah. So you're going to have to do some negotiating and some thinking and some strategizing. It's too much to run all this in this class. So when you have this happen, it's a case-by-case basis. Call me. I will help you run the math on this. But understand, commission, title, closing costs. The lender's closing costs, about 1.5% is what I've seen. Somewhere around there is the total loan costs to close, or like an originate. Think of it as like an origination charge. Okay?
For the loan officer?
Yeah.
Yeah.
So
and that was
yeah.
in this process, the one that we're going through right now. What I found very helpful and encouraging that we were gonna be successful is I asked the listing agent to talk with the seller and get me the information on the lender, which was Cooper. Cooper was the one
Mr. Cooper,
running it,
yeah.
and Mr. Cooper, but it was a Rocket Mortgage. But the servicer for the Rocket Mortgage was Mr. Cooper. He, somewhere in their system, allowed me or gave me authorization to call them, because when I called and said who I was, they're like, do you have a code? He had to have his last four and a date of birth. And I gave that, and they cleared me, and they gave me all the information on the loan, what the origination fee was going to be for them to assume it. And then they transferred that. Once they confirmed that it was assumable, they transferred it to Rocket, and Rocket called me and said, are you representing the buyer? And this is what we need from the buyer. We put them in contact. We had to send them the contract, that we had the sale, the offer contract.
Did you
all
do this? You did this before going under contract. You consulted.
Well, we already under contract.
Okay.
I did that after because we had to have it for the assumption. We needed to know what the balance was. So I had to call with Mr. Cooper before the offer.
Yeah.
To fill out the addendum after the offer got submitted, and Mr. Cooper turned it back over to Rocket Mortgage for the assumption. Then the assumption officer at Rocket is
Let me because that's a lot of moving parts. Let me simplify this. Before making the offer, you should probably have the seller should probably have a conversation with their lender.
Yes.
Hey guys, talk with your lender about the payoff and here's the two magic things. Here, I'll put it back on here so we can get a nice little before the offer. Okay. So before making the offer, you want the payoff.
Yep.
Payoff. You want to know, and I think they can even tell you around what the origination, the charges.
Yep.
Charges for the assumption, so your client can start getting the numbers together if they have the money for this. And finally, you want to have the contact info for the department. That's always something like that. Who do we talk to make all this work? Contact info. And I'd say that's before going under contract.
And they have to approve it. The seller has to approve you having conversations with whoever they send you.
Yes. So the seller's going to have to an approval and then approval for communication, of course.
Yeah,
Approval for communication.
for sure.
From seller, right?
The seller has to give that approval. And I would try. This can be done after going under contract. I would try to get this started before.
Which you did, and you'll need it for the addendum.
Yeah.
Because
The payoff is in there.
The assumption addendum that you fill out that you submit with your offer has the information on there that the
And we're going to look at that in
Yeah.
2 seconds.
Yeah.
Yeah. So before going under contract, these are the considerations: payoff charges, contact info for the department, the appropriate department, and trying to line up that approval for your
You
client to
have to have
communicate with.
it before it because you need to put that on the addendum, don't you?
Bingo. Yes,
Okay.
yes. So
Okay.
before going under contract, there's another step. You need to consult with the lender. They have to let you do this,
Mhm.
but you want to get these pieces together, and you need them to get your offer together.
Mhm.
Okay?
Okay, let me get a picture of that. 'Cause
Absolutely, and I'm recording this too. So
Yeah.
have fun. Get it.
I'll
Yeah.
go later. Mhm.
Cool.
Thank you.
So you go before making the offer. Then the next part is putting together. So before and now to offer. Let's have some fun. All right, I have a handy dandy copy of an addendum that you need to use with this, called the loan assumption addendum. Okay? You see this, everyone? Now, I'm going to give you some best practices with this. Who's seen the seller financing addendum? Anybody here? There's some similarities. Like at the beginning, credit documentation. They need to be able to obviously qualify for the existing loan. They have to be qualified by the lender. Okay? It's not like, oh, anyone can just take on $1 million loan. You can't. They're going to have to already be able to qualify for it. So I did some asking around on some best practices and such, and some of the stuff that came up, and I think is a really good way to manage that, is you don't need who is not deciding if they're creditworthy. Who's not? The seller. The seller. Well, I know that's like, just humor me for a second like that. That seller doesn't need their tax returns. That shouldn't really matter. So this, yes, like unlike seller financing addendum where the seller is holding that note, they're not holding the note. They don't really need that, but it mirrors the seller financing addendum, that language. And here's where I'm getting at. I don't want to give them all this crap. Okay? Here's the easy way to do it. Check that box. Pre-qualification letter from a lender. That's what I would do now. That's how I would do this. So, sorry, Jack, I know this. You're going to have a lender that's a friend. I'd take them out for a really nice dinner or refer them some business guys because, unfortunately, they're not going to make any damn money off this. Let's just be honest, okay? But get them to give a pre-qual letter for your client, okay? Attach that pre-qual letter with your offer and this. So, and that I think most sellers would be, okay, they see that they can qualify for a $280K home. Okay, they're fine. Okay, they feel comfortable enough to accept that offer and let you go through that approval process with the other lender. Does that make sense, guys? Please stop me. Asher, does this make sense? Anybody?
Okay, how do you get a pre-qual letter?
You talk to another lender just like you get any other pre-qual letter. So instead of attaching your tax returns, credit report, and all this other crap on here, let's cut straight to the chase. Can they afford this home? Is essentially what you want to prove up
Okay, so
to
make sure
that
they
seller.
have pre-qualification.
A pre-qual letter. Pre-approval, pre-qualification letter.
Okay.
Okay? I'm
And if
circumnavigating.
you're working with them already, hopefully you've got that.
Yeah.
You know,
Okay. Yeah.
before,
Makes
because
sense.
you got to
Otherwise,
figure
we
out
can
how
look
to.
Exactly. That's the exact point. You get this. Sorry, Jack. I know this is poor Jack is like dying.
He's like, why am I doing here?
So here's what happens. You give that to them and they say, okay, that's great. This is an addendum with your offer. Buyer's credit approval. Okay, you have a protection. The seller can terminate if they don't like the information in there. If you provide it to them, when you provide it to them, they're not going to. Basically, there is an out for the seller. Okay, when they look at their pre-qual letter that you're giving them, which is kind of weird, but that's just how it's made. Okay. Then you need to be able to show the payable amount, the monthly payment, includes principal and interest and the reserves, and you'll get that from them, the lender. Okay, this is it. It's just you check that unpaid balance. Okay, and they're not a note payable to Mr. Cooper's, I guess, or whatever they had it as. Ask them for the name, unpaid balance at closing. Get them to run that exact number. If the unpaid balance at closing, as of the closing, it varies from the balance above, they'll make a cash payable difference of 100. It's not going to be much. Few hundred. If let's say the close, because you're talking the exact closing date might change. So maybe $500 difference or something like that. I would put in there if the balance is different by $500, wiggle room back and forth. Okay, think about this. Your closing day, your principal, your balance goes down. They make another mortgage payment. What happens? That goes down a little bit. So they might have to bring more cash to bridge that difference between that amount. Put $500 in there. I know this is math can be complicated. Based on the closing date and what happens, that could change a little bit. Put $500. Cash, and I would just do cash payable at closing. Okay? Comprende? And when you fill this out the first time, grab me. But what I'm saying is, like, you're giving it a little bit of wiggle room. Okay? If they can't come to terms with it, you're going to get the note. Within 7 days after the effective date, the seller will give the buyer copies of the notes to be assumed. Well, you're going to have that stuff probably very quickly. You're going to copy of the notes and the information. But basically, if you did your job and you got the contact information for that department, you go under contract. Okay, here, instead of hearing it from me, you guys went under contract. Tell me what happened for you, Ryan.
Well, see, we actually put a timeline up top.
Okay.
In the first one, because we didn't know, even though we had the pre-approval letter from Jack, by the way, we went ahead and did the credit report verification of employment, but we didn't do the last two, I don't think. We submitted as soon as we went in. We had 21 days to do it. Yeah, we had the option period, and for down below within the option period, the seller had given us all the information for the assumption for them to start working with them, because we wanted that done within the 10 days that we'd asked for in the option period to make sure that information there
was the same.
So
if you have that, so what he's saying on this is you want to make sure everything's lining up financially, and that's where that also, if there was a change of more $500 than what they owe, that would give them an out too on that. So you would be protected on there. So there's another layer of protection if there's a variation from what they claim to you guys or what you were told over the phone before going under contract. I know this is complicated because you're dealing with a number that's moving every month, okay, by slight amounts, okay. So you go under contract. They applied. They reached out to that department and basically applied like they were to any other loan. I would imagine.
Give all the documents he would do for
Now that stuff does not go to that's not what's going to the lender. They're going to go to the lender and have to apply directly.
Yeah, which they did. They got a link on a portal through Rocket Mortgage, and they had to upload everything into that portal.
So they are actually applying for the loan while under contract. Okay? That's part of also why this takes a little longer. So there's a few elements to this that are different than a normal sales transaction.
So the buyer has to stay with the servicing
Yes.
company?
Yeah, you're just basically you're just
You
switching
write
places.
the check now to the seller's loan originator.
You're swapping places with them is essentially it. That's it, for a small nominal fee. And whatever you're giving the seller, bribing the seller by going above that amount that they owe. That's really what this comes down to. You could use all this other language like closing costs, ask them to pay Section 12 closing costs, but at the end of the day, the math is simple. Who's bringing the cash to get, what amount of cash are you giving that seller above asking price, above the loan amount? That's really, to really simplify this, you have to think in those terms. Cash above the principal of the note. That's it. That's really it. So they apply. While they're under contract, you guys worked it out with them. They got approved, and you did inspections just like normal.
Yep.
You had. Did y'all do an
We did
appraisal? There's no
repairs.
appraisal. I don't
No,
think there's
no
an appraisal.
appraisal.
So that's another thing too that's really nice. There's no appraisal.
Well, Brad, I was going to bring something up.
Go ahead.
This is not for y'all as a listing agent. Since there's no appraisal, and I'm offering a 2.0 rate, and say the house is worth 260, why not ask 270? I'm giving you.
Yeah.
I'm giving you a rate that's unbelievable.
Yeah.
We want 270 for the house.
There is absolutely value
why
in
you can
this.
do
Well, if it's already really tight, but that means you're hinging this all on a buyer. Retro rate is good for sellers. This is the saving grace for people who bought new construction in 21 and 22.
At a low rate.
at a low rate, but they are now in Alamo Ranch, and they literally owe the same amount as what they're basically what the value of the home is now. This is a double-edged blade. It's valuable for sellers.
With no appraisal, you can
ask whatever the hell you want.
Whatever you want for the house.
Yeah.
You pay the realtor commission.
But but within reason.
Yeah,
Within reason.
Yeah, but
Within
you know
reason.
what? If I'm gonna, instead of a 6.6% rate versus a 2% rate today, that's worth $50,000
Would
in the long term.
Over 30
would this
years.
help
Yeah.
people that had a lot of cash up front but didn't have the best credit?
That's kind of where
They still have to qualify.
Yeah,
And that's the key.
Yeah.
They-
Okay. So say the house was $300,000 house, right?
Okay.
And the loan balance, just say for some reason, is only 200, and the clients have the 100 to put down on it. Would that make a difference? Because now they only have a mortgage for 200.
Okay, debt to income ratio?
Yeah.
Yes. Actually, yes.
Okay.
Because
and you mentioned that if you have
Yeah.
terrible credit,
Mhm.
you have to still qualify.
yeah.
But on government loans, your credit score is going to be helps on your rate anyway. The lower the credit score, the worse rate you're going to get.
Yeah.
So if you have a terrible credit score, it's another thing.
As long as you
But I
qualify,
think-
you
I
get
think
it.
there was-
Qualify.
Yeah, but I think there was something in the process that somebody asked me,
I don't know.
are they above 625? Somewhere, I don't know whether it was the assumption officer, and I knew both of the buyers
Right.
were well above that, but somebody, whether it was Mr. Cooper or the assumption, somebody asked me in the conversation that I was having with the lender, it can only be assumed if they have a credit score above this. Not about their
Yeah.
And
finances,
that's the
but
overlay of the original
So-
lender.
yeah.
So don't
So
they?
if some lenders have an overlay of less, so then it would be
They might
Yeah.
basically they still got to qualify
yeah.
under
Is there a magic number with the?
It just depends on what. the
probably
overlay
over
is.
625, 620, 625
I'd say
above
620.
that. Six,
I'd say
yeah.
620, but that's going to depend on the originator.
They are still qualifying for the loan. But because the interest rate makes the payment so much less, it actually can stretch their debt to income ratio into a higher sales price than they would typically be able to afford because the payment's less. Does that? I think you get what I'm
Yeah,
saying on
yeah.
that. So like this is very interesting for a savvy buyer that wants an incredible deal. Here's the challenge. How do you tell someone about this? I've done this with friends before back in the day. I do not go into all the details at the beginning. I just say you can take on this interest rate, you need a little bit more cash than normal sometimes. You should probably have about 10% cash sitting around, 10 to 15% of the value of the property sitting around, and we're going to have to work our asses off to find this property. That's what I told my friend. This is a long time ago. I said, if you want to get a good interest rate, you want to play this game, we can do this. We can do this in a savvy way, but you need to understand it's going to take longer to close, it's going to be more work, and it might not be the perfect home, but by God, if we pull this off, you're going to get an insanely good payment.
And honestly, I thought the lender was going to be have more restrictions and be a little bit less, forthcoming with how we did this, because they're giving an interest rate that's, getting an interest rate that's so low that I thought they would find loopholes to get out of having to do the assumption, and they've been nothing but friendly.
As long as they get their money, they're fine. As long as they qualified, they're getting a little
Yeah.
extra money for the work of transferring this loan over. They're happy. They don't care, and they're required by law to do this. So they're a little. My understanding is I actually talked to a banker who deals with this kind of stuff. He said this process, there's going to be nuances to this, like weird closing dates, some weird stuff because it's not the beaten path. But he said like they're scared to say no. Is what he told me.
They're all assumable.
They're all assumable.
Yeah.
They want to make it work. So like it's actually they're usually pretty easy to work with. They don't make this hard
So far.
so far. Like typically, and I've dealt with this year alone. This is the third one we've done this year. So like they work.
Yeah,
That I'm aware of.
they bought that loan for that rate anyway.
Yeah.
So that's what they're anticipating.
That's what
they're
they've
making
sold
over
it
the life
for,
of the
whatever. Or,
Yeah.
yeah.
So they're gonna have an escrow account. They're gonna have all this other stuff they need to fund too, guys. So remember on that. That means they're going to have some cash. Like they should probably have 15%. Just you need to run the numbers. They're going to
Did
have
you
to
say
have.
20 earlier?
Like it depends on what they
No,
owe.
that's
owe.
on the down payment. That's not
Oh,
Like
okay.
it's not going to be just that down payment difference.
Mhm.
The buyer will have to bring other costs to closing, and they're going to have to run the numbers.
So it might be 30%.
It might be 20%, something like you're going to have to just talk to them and run it on an individual level. Because you're going to have to fund your escrow account. You're going to have that origination charge or whatever they're calling it, their closing costs that they charge on top of that. Does that make sense? Yeah.
And like we were saying, Brad, this is not for everybody. This
It's
is
not.
for that right client that has cash in their hand.
Yeah. Like
They just sold their house.
40K sitting around in the
Yeah.
bank would be a nice thing to have. Something like that. Not everyone has it. That's true. So it's not for everybody. But kidneys are going these days, I think about, 45K, and, man, I mean, Asher, yours is probably really valuable too. Victoria, she can live with you having the one less kidney. Yeah. Once you've had children, you've done. You know what my dad told me? He told me your job is done in life. He says you've had kids, you're worthless now. I was like,
Wow. Thanks, Dad.
exactly. That was not very
Now
nice.
stop lying to you.
Yeah.
It's like saying Santa Claus exists.
Yeah.
You have to take care of those kids and they have to have grandchildren, otherwise you're...
I got to be
No more
careful with the
games.
jokes I give with Dad, but I told him I'm going to send him up to Canada to go sleep in a pod or something like that, Sorry, bad joke. We're really mean to each other in our family, like my dad and I. Sorry, I'm sorry. I thought I was like, oh my God, actually, bad joke. Okay. Anyways, assumption fee. Okay, this is where if there's a difference, I would put 500 and I would put 0.2% in there. Okay, assumption fee. If it's larger, it changes. Like the amount that the payoff goes more than $500, which it really shouldn't, or $1,000, something like that. And then if the interest rates, but you're going to know the interest rate already though, so there really shouldn't be much variance in that I've ever seen. It's identical to what they quote you. So 0.2%, I can't think of any reason why that would change. So the rest of this is dealing with some issues around releasing of information, allowing them to talk to the lender is baked into this addendum too, the permission to do that. And on the 1 to 4, so again, this takes the place of your third-party financing addendum. Okay? So if I go look at, let's close this out of here. I go look at here, my 1 to 4. Let's just for fun. Look,
Right there.
there it is. Loan assumption addendum. Instead of third-party financing addendum, loan assumption addendum. Easy. Okay? Pretty straightforward. Questions, guys? Any questions on this? Does this make sense? I know this is a lot of information in a
So
short time.
there's just a lot of planning and communication with both agents before there's even an offer written up, basically.
Yeah. So to recap, this first step is a conversation with the listing agent. You need to talk with them. You need to get that information we talked about. Balance, costs, approval, contact information. You need that. I would try to start that conversation before going under contract to make sure this is doable. Okay? Understand, if it's a VA loan, I cannot stress this enough, even though they might say it's assumable, there's a lot of agents that hear that the VA loan's assumable, and then when they talk with the lender and the lender tells the seller, I've had this happen before, hey, sorry, your eligibility is still going to be used up, they freak out. So you should proactively make sure they understand that. If they're not actively, even if they're advertising the home as VA assumable, I would make sure they've talked to their client and they understand that. Because the last thing you want is a surprise where they freak out and then they just shut down. Okay? I don't want that to happen. Okay? Most good agents, if the agent has any type of competency, will explain that to their client. But there are agents out there. Should we assume that an agent on the other side is educated? No. So a professional prepares for problems before they happen. Have the conversation. If it's FHA, who cares? Listen, they're gone. They're done. They're off the note. They move on with their life, and the seller gets whatever difference they get from that and all the closing costs at closing. So it can be really good. Questions? Any questions? Brian, what's their interest rate?
2.75. Yeah.
Versus like what? 5.8 for VA or something like that?
5.79. Hey,
Yeah.
Jack,
The
you
one
got
was
them?
5.5.
5.5.
Or 5.5.
Yeah.
Okay.
Yeah.
Okay, guys.
Pretty good.
We're gonna make once we're finishing up. Here's what's gonna happen at the company level. The big thing right now for all of us, and we have the competition running now too, and we're posting up the rules for it, is this: the meal at Bohannon's. Okay, for passing this out, and this is the big talking point for content right now is the 6-month market report. The next thing we're gonna be making content for, and like I'm gonna actually make a 1-pager on this to help kind of explain the value and run a very basic analysis, like a breakdown on this, will be the next cycle of content that we create for you guys. Okay. Again, how does your client feel about all this, Brian?
Well, they're good. They're excited. Yep.
Super duper mega excited.
Yeah, and it also from their timeline, because their lease doesn't end until the end of July anyways. So they, from the time standpoint, and to find it this early in our buy cycle, because we were planning, we thought 2 to 3 months before they found the house, got under contract, and they got with this deal, it came on much quicker. So the timeline was not an issue. It was like, we're saving enough that even if we have to pay a month's worth of lease and just migrate into the new house, we're good.
One of our agents right now, a young man, is doing this. He's looking for, this is his first home that he's buying, is using this program. And he's just going to hunt like a hawk until he
Well, he
finds
spent a lot of time
exactly.
in the retro.
Yeah,
he's-
you probably know who I'm
Yeah,
talking about
exactly.
already. Yeah,
Yeah.
a certain soccer
Yeah.
referee,
Yeah.
that's
Yeah.
got a lot of
Yeah.
free time and is very analytical.
Yes.
Yeah. Oh, he's
Nice and
excited.
fun.
Yeah, he is super duper excited about this. And like, yeah, guys, I mean, this is cool. It's a life changer.
At today's rate and the prices, yeah.
Yeah. If you could pull it off, I mean, for anyone that's a savvy young buyer looking for a good deal out there. Now, gifts, Jack.
Ooh, that's a good
I
question.
don't know.
My understanding when I looked into this, we had someone get a gift from a parent.
It's up to the lender.
It's up to the lender, but they got a gift under an FHA loan this year, and they pulled it off. So they did it. I can't guarantee all lenders. This is where things get a little funny. So, like, I don't know, maybe a family member that's got some cash sitting around, might want to help someone out a little bit, because, yeah, I'm just having some fun with you, Asher.
I
But,
know.
like,
I know exactly who you're talking about.
maybe they could do some yard work for them or something like that. I'm just screwing.
Some cutting down some cedar trees on their new property.
Site work, yeah. But like, this really does open up a lot of doors if you're smart and creative about it. Okay, before we end this, any more questions, guys, on this? Any questions? I think we covered this pretty well. Yeah. Cool. Awesome, guys. We'll get some materials made. Thank you all for coming to the class. Thank you, Jack. Thank you, Jack.
Stop the
Thank you, Jack.
What's that?
Stop and I'll make a comment. 'Cause you gotta